So, Syed, welcome and great to have you here. I've been really looking forward to this conversation. As you know, at Kalpvriksh Global, my work revolves around helping families and professionals make more informed and goal oriented investment decisions. And recently, with SEBI introducing specialized investment funds or SIFs, as they are being called, there's been a lot of curiosity and honestly, a lot of confusion too. Therefore, it's great that we are having this conversation because, given your vantage point at CAMS and your deep understanding of how the industry is evolving overall, I thought it would be really valuable for the two of us to sit together and unpack this category properly. So, thank you for making the time. First and foremost, I'll request you to please introduce yourself for the benefit of our viewers.
Okay. So thank you. Thank you so much, Rakhi. Always a pleasure to talk to you. And yeah, good to be here talking to your audience. Now, as far as my role is concerned, I am a chief program officer in CAMS. Okay. And I lead specific strategy and growth programs across key verticals in the investment landscape and the retirement services landscape. It includes mutual funds, SIFs, the topic of interest today, NPS, and a few other areas, the National Pension System, and a few other areas. And as part of this role, I'm responsible for driving revenue growth, market engagement, strategic partnerships with asset managers, regulators, and distributors. Prior to this, you know very well that I've done two stints. The first one with you in Unilever for close to 17 years, and the other one in DXC Technology in the core IT space for nearly 10 years. Again, it's truly a pleasure to discuss this, what I would call a transformative category, okay, with the audience on your channel, Rakhi.
Thank you, Syed, and really vast experience across multiple sectors. Really pleasure to have you with us. So let's start off by asking the basic question: what exactly is a specialized investment fund, and where does it sit in the whole, mutual fund universe, where you have mutual funds, you have PMS, AIF, NPS, etc. So where exactly does this product sit?
Okay, a perfect question to start. Now, for those who are already familiar with the mutual funds, SIF is also a mutual fund with a little bit of a twist. The structure is very similar. Okay, they operate under the SEBI's mutual fund framework, same transparency, daily NAV calculations, caps on the expense ratios allowed, and the reporting and regulatory requirements. So what is the difference? The key difference is flexibility. The fund managers in the AMCs working on SIFs get very sophisticated tools to manage the portfolios. I would say particularly the ability to use derivatives, okay, in ways in which traditional mutual funds cannot or not allowed to do. However, because these strategies are more sophisticated, SEBI has set a minimum investment of rupees 10 lakh per investor at a PAN level across all SIFs within a fund house. So the reason for this is to ensure that only aware and experienced investors are participating in this category. So in the mutual fund universe, the SIFs are sitting along with the traditional categories. I'll just give you an example. You said it is very complex, but I'll give you a very simple set of examples to understand how it's a natural extension. For example, a mutual fund flexi-cap fund becomes an equity long-short SIF. Same flexi-cap approach, but with 25% shorting capability. Similarly, a mid and small cap fund in mutual funds becomes a X top 100 SIF, okay, with a mid and small cap exposure, again with the shorting that we spoke about on the earlier one. Sectoral and thematic funds in the MF space become sector rotation SIFs with the long shorts strategically used in SIF. And SIFs are offering something very unique, the ability to benefit both from rising and falling markets using the strategies that we spoke on long short, while at the same time preserving and maintaining the guardrails, the regulatory guardrails that prevent excessive risk taking. This is how Rakhi SIFs are fitting right alongside MFs, but with a supercharged flexibility.
Got it. Got it. That's super clear, Syed. But it kind of leads me to a question. If they are so similar to mutual funds, or rather an extension of mutual funds, with extra flexibility and the option to use derivatives, why did SEBI feel the need to introduce this new category at all? What gap is SEBI trying to fill here?
SEBI identified a big gap, a big significant gap in the investment landscape. I call this a no man's land between mutual fund and AFPMS. Let me explain the problem. Today, investors have two primary choices. Choice number one, traditional MFs on one side, very safe, regulated, with minimum as low as 500 rupees, but sometimes index hugging, okay, and very limited in their ability to deliver differentiated returns. On the other side, AIF and PMS, customized, flexible, but need 50 lakh rupees or a crore rupee minimum, which puts them out of reach even for affluent investors. So, what is the middle path? That's where the SIFs come in. SIFs carve out a very compelling middle path, bringing PMS like flexibility and high conviction strategies, and bringing in mutual fund like accessibility, transparency, and regulatory oversight. So, for high net worth investors who want more than traditional funds but cannot access PMS products, SIF solves the problem. Okay, and additionally, SIFs allow investments in a broader range of assets, not just stocks and bonds. You can invest in REITs, InvITs, strategically use derivatives with multiple investment approaches, which we'll talk about as we continue the conversation. This gives the fund managers very tactical options that were not available in the mutual fund space. These are the reasons why SEBI has introduced this new category of SIF.
Got it, got it. No, I like your analogy of how it's a middle path between, mutual funds, which are available for all retail investors, and PMS, AIF, which have been more like HNI kind of products because of their minimum ticket sizes. And this now comes in as a good middle path. But then who exactly are SIFs meant for? Is it again only for HNIs like PMS and AIFs? Or is it even, something that retail investors can look at?
Definitely for HNIs and emerging HNIs. But let me be clear about, say, to whom this is suitable for the ideal client profile. One is HNIs, okay, who are seeking, like what you are mentioning, a PMS-like model or a customization without the 50 lakh minimum constraint. And it is also suitable for millennials, okay, young professionals who want themes that they believe in. For example, themes like EVs, semiconductors, tech, or ESG with professional management, or investors who are currently in direct equity. Many direct equity investors think they're all Warren Buffett's stock picking geniuses until one big bad bet wipes out their gains. For these kind of guys in direct equity who can afford this 10 lakhs, this is a very, very good product. Similarly, we are also expecting, our research shows that there will be many F&O traders, okay, who are looking for strategy, okay, over speculation that they're currently doing. Instead of punting on options, they now get with SIFs a very well researched, okay, and a very actively managed high conviction strategies using derivatives. So F&O traders can be good, say, investors or possibilities of this, or real estate investors who are stuck in illiquid properties. Now, SIFs help them tap into infra themes, okay, like REIT, InvIT, in a liquid and a regulated manner. So I would say that these are the kind of investors who will be good candidates for SIF. But Rakhi, on the same breath, now let me also cover who should not invest in SIFs, who should not come near this space, please. One, first-time investors, okay, who have never seen a full market cycle. Sorry, not for you. Or retirees, conservative retirees who are depending on the money, who are depending on the monthly cash flow from debt funds or annuities, etc. No, not for you. Similarly, investors who cannot commit the 10 lakh without disrupting their emergency funds or essential goals. Please don't touch your emergency funds for this. And clients who get very anxious, even with standard hybrid fund like volatility. Okay, then it is not for them. So the critical message, we spoke about whom it is ideal for: the clients with a higher risk appetite, a minimum 5-year investment horizon. It is very, very suitable. And for those like first time, okay, or very anxious ones, or retirees, or touching their emergency funds, etc., it's a no-no. So that's the profile of investors that we are looking for in the SIF space, Rakhi.
Perfect, perfect. Thanks, Ed. This adds a lot of clarity. And I remember one study done by SEBI where they said that almost more than 95% of investors who do FNO trading are actually losing money. So for even people who want to take exposure to FNO, this then becomes a good instrument where it is professionally managed. There is some bit of derivative exposure, but it is more professionally managed and therefore increases your chances of making profit significantly. So,
That's right.
thanks for framing this very well in terms of who should invest and more importantly, who should not invest.
That's right. That's right. And I was talking about the reasons why SEBI was introducing this, okay, as a middle path. And what you just spoke about, Rakhi, is another reason why SEBI did this. Because, like you said, 2 years before, their study was showing that 94-95% of the FNO guys are losing money. The individuals especially are losing money. So, and I don't know personally anyone who has made money in FNOs. So this is one more reason why SEBI brought in this product, so that it comes in a very regulated, okay, and actively managed with professional AMCs rather than individuals trying their punting on it. That's one more valid reason why SEBI brought this in, Rakhi.
Got it, got it. So, Syed, now moving on, you said that it's a product for HNIs. From an HNI point of view, how are SIFs now actually different from traditional mutual funds that, any HNI would already have in their portfolio, or say a mix of mutual fund, PMS, EIF that they would already have in their portfolio? And specifically from mutual funds, how do these SIFs actually differ from a strategy perspective, from a portfolio perspective, and also from a risk return perspective?
Okay, I look at areas where they are similar and I look for areas where they are different. But first, let us look at the similarity part between MF and SIF. Now, SIFs maintain the same simplicity of mutual funds. Okay, the same SIP, STP, SWP, all are available. Okay, and the liquidity is T+2 redemption for most of the schemes. And we spoke about SEBI oversight, I think 2 or 3 times till now. And the same expense ratio caps, 2.25% max, exactly similar to mutual funds. And one very good similarity is on taxation that you touched upon. SIFs are following the mutual fund taxation rules. Treatment is based on whether the fund is equity oriented, where 65% or more is equity exposure, or debt or hybrid oriented. And if it is an equity oriented SIF, then you have the very favorable equity like taxes, STCG at 20% and long-term capital gains at 12.5%, which makes it really, really attractive. So SIFs are offering very superior tax efficiency when compared to PMS and AIF because of the similarity to the mutual fund like structure. Okay, very fixed, very favorable capital gains rates. So this is very much unlike PMS, where the securities are in your name, the investor's name, and every time there is a churn in the portfolio, okay, taxing happens. Okay, like treating it like a personal gain, or even AF Cat 3, okay, where it's a fund level tax on certain income. So in the case of SIFs, like MF, it defers all tax until redemption. So if you look at the primary areas, okay, where MF and SIF are different, we spoke about the similarities, all positive, okay, very simple to operate, all features available, favorable taxation, SEBI regulation, guardrails, all the similarities were favorable to SIF. Similarly, the differences are also favorable. Difference number 1 will be the investment flexibility, okay, on the long short available in SIFs, which is not available in mutual funds, which is a very, very good place to be in. Two, the risk part. Okay, the traditional MFs, how do they manage risk? You have to sell your positions or you have to stay in cash. SIFs, they manage risks actively using shorts and derivatives. So if I have to compare it with a car, okay, standard mutual fund is like a car that can only move forward. SIF is like a car with both reverse gear, better brakes, same road, same traffic rules, but better control is how I would put it. Rakhi, the differences and similarities.
No, thanks, Syed. This is very clear. That in terms of structure, they obviously have a very distinct advantage over PMS and AIF because they are similar to mutual fund in terms of structures, in terms of regulation, in terms of reporting transparency, in terms of tax and cost efficiencies. So that makes it really, really much more like mutual funds. And definitely better than PMS, traditional PMS and AIF. And the differences, like you said, also sound positive. So can you give us some flavor of the kind of strategies that SIFs are allowed to run that normal mutual funds cannot? Yeah.
So maybe what I will do is I'll try to keep it simple, explain it in a simple manner. One, let me take the equity long short strategy. Okay, and these strategies use some interesting techniques. For example, a market neutral strategy. We can go long on undervalued stocks and short on overvalued ones within the same sector. For example, the fund manager can go long on Maruti and short on Tata Motors, okay, based on the valuation metrics and outlook. Similarly, within sectors, sector rotation, you can go overweight on promising sectors like banks, and still you can do shorting on declining sectors like IT. See, you get the best of both worlds. Go long on one which is, say, doing well, okay, and the share price is increasing. Go short where you know that the sector is going to decline. And this captures the sector rotation alpha. Or quality part, long on high quality companies, okay, and go short on low quality peers within the same sector, which very well you know, and it will capture the quality premium, okay, while hedging the market risk. So these are some techniques used in equity long short, okay, going undervaluing on undervalued stocks, going long on those, and overvalued ones going short on those, knowing that this is how the market is going to behave from an outlook standpoint. Similarly, if you look at hybrid long short, a typical portfolio construction, okay, let me take a specific fund without naming it. 60 to 70% of the folio is in fixed income plus arbitrage. So a very core stable return type of base, which is also tax efficient. So 60 to 70% of money kept there. 10% of the stock, special situations, short-term trades, IPOs, or event-driven opportunities. 10 to 20% in lower risk derivatives, okay, like covered calls and spreads. And the balance is kept on dynamic allocation based on opportunities. So if you look at this mix in this hybrid long short, it is like an arbitrage fund from a safety standpoint, but the returns are 2% higher than arbitrage. And if you take the risk standpoint, it is 1/3 the risk of an equity savings fund. So that's the advantage. You have an arbitrage-like safety, much better returns. And if you take the equity comparable risk, it is only 1/3. So SIFs, what they are doing is they are turning complex strategies into the real portfolio power. Okay, and this is the edge that HNIs get if they get in and invest in SIFs today. Hope this helps in answering, say, and giving a flavor, Rakhi, in terms of, say, how these equity long short and hybrid long short operate.
Yeah. So what I took from the discussion, Syed, is when you said equity long short funds, they will give you equity plus returns and equity minus volatility. And same for hybrid funds, they will give you arbitrage plus returns because of the additional strategies they deploy, but at the same time, arbitrage minus volatility or similar volatility as arbitrage, which is very low volatility.
Yeah.
Uh,
So let me have a small clarification here. So the equity long short, we cannot promise a equity
hmm,
plus kind of returns. Okay, it
hmm,
is because yes, while there are investments in equity which deliver say significant returns, like what happens on plain equity, large cap kind of funds, okay, or mid small cap kind of funds, it is a
hmm.
mix between investments in equity and also the derivatives and other products. Okay, so to that extent, it may not be as high, okay, as an equity fund, but the risk becomes one third. Okay, so the returns will be between equity and arbitrage, but the risks will be one third of equity.
Got it. Got it. So basically, an equity long short fund will aim to give equity like returns, but with a much lower volatility. But when you look at a hybrid long short fund, it will have similar volatility to an arbitrage fund, which is basically very low volatility, but the returns will be slightly higher than a arbitrage fund. Is
Exactly.
that
If
the
an
right?
arbitrage fund, yeah, that's right. If an arbitrage fund is currently giving, say, 8%,
7%. Yeah.
and pre-tax and then 6% net. Now this will give plus 2 to 3% higher. You can
Got it.
expect around 8%. Okay. And when I'm saying this, now, even the current funds which have launched, okay,
Hmm.
the initial ones where say which were launched in October, there were two hybrid long short funds which were launched, and both are now at 2 to 3% higher than the start point. So, which
Absolutely.
means at the end of the year, it is on track, even in a very volatile market like what we are seeing now. If they were able to do that, say 2.3 to 3.3%, then I'm sure at the end of the year, at least it will be an 8%.
Absolutely, absolutely. No, I think fair point. Even though it's been a very, early days right now, arbitrage fund seems to be, delivering what they promise, almost all of them that are in the market for last 3, 4 months. But from an opportunity perspective, do you think it is the right time for HNIs to look at SIFs now, especially that they are this early stage? Or should it be more a wait and watch kind of an approach, give it some time, let the category settle? Or you would say, go for it.
Okay, you know what I will say? Yeah, it's go for it. Okay, and the reason for saying that, or there are multiple reasons for saying that. See, number one, very accessible entry point, okay, for
Hmm.
HNIs who are always waiting for something like this, but cannot afford the 50 lakh or 1 crore that we spoke about. And it democratizes the PMS style customization. Okay, and that is one. So very accessible entry point is reason number one. Superior flexibility, okay, that is available for the fund manager using whatever we spoke about, high conviction bets in 10 to 30 stocks, or going long shots, etc. Superior flexibility and early mover advantage. See, entering the market now helps build the track record through market cycles. And the top asset managers, okay, like SBI, ICICI, Tata, Bandhan, and 361 have already launched their funds. Okay, and a few others too. I'm not rattling out the full list. For example, SBI Mutual Fund, Magnum, hybrid long short that we spoke about, a multi-asset
Yeah.
strategy, covered calls, arbitrage, okay, unhedged equity, stable returns that you mentioned, Rakhi, in very volatile markets. So SBI Mutual Fund, Magnum is available, or iPro, iSIF, again, a hybrid long short fund. And iPro has introduced equity X top 100 also. Okay, again, a long short one fund has been introduced. Bandhan has introduced Aruda, hybrid long short. Tata, titanium hybrid long short. Okay, or 361 has launched Dyna SIF last week. So there are multiple options to make the entry, and really top class fund managers from these large AMCs, okay, are on the job. And as a result, in the last, say, 3 to 4 months of the launch, okay, SIF is a new one, right, in the market. It's only 3 to 4 months since it has been launched, but we see the AUMs touching 7,000 crores already. So we are at the beginning of, like what I was mentioning at the beginning of our talk, something which is truly transformative. And whoever is recognizing it early will be significantly ahead. And that's why, okay, the positivity comes in recommending it to HNIs for looking at SIFs right away.
Very clear, very clear. So one question here, given that this is a very new category, what do you have to say about the experience of fund managers in managing these complex strategies? Do you see that most of these AMCs have been able to recruit experienced fund managers with this kind of experience, given that it's a very new category?
They have been. Okay, and the names that I was talking about, okay, are all veterans in the market. And I personally know the fund managers operating in each of these AMCs, and you can also see them doing the education and market development, okay, across a wide combination of social media, etc., with authority. Okay, so really good names who are there, and there are some more AMCs who are yet to launch. Okay, and they have very classic names. Okay, and so people like Andrew, whom you interviewed, Rakhi, I think a few months before. Okay, very, very famous name in the market. So these are the kind of people who are working on SIFs within the AMCs. Very famous, very strong names, and who have been there and done that. Okay, those are the kind of people in the AMCs working on this now.
No, absolutely. Someone like Andrew, who's run, multiple hedge funds and long short AIFs, seems like the right fund manager to do this kind of a strategy. But good to know that there are more such experienced fund managers. And I think this really is important for someone who's getting into this category new to look into. That the fund manager who's actually taking these day-to-day calls has experience in managing, these kind of strategies.
Yeah. See, we're talking about legends. We are talking about people like Naren and IPRO, and a very strong fund manager called Gaurav from SBI. So these are all really strong people in this. Personally, comfortable in investing my money.
Absolutely, absolutely. So I would like to come back to the question on risk. I know you mentioned how these strategies actually manage risk better, but and they are actually, some of them are lower risk than a pure equity strategy. But can you delve a little bit more deeper into that, on how risk management actually works in SIFs?
I think we touched upon a little bit, okay, when we spoke earlier. But having said that, so I'm glad you asked this again, because there is a significant myth mongering, okay, around SIFs, okay, that need to be addressed. So if I have to give an one-line answer, it will be they are not riskier than their mutual fund counterparts. Okay, SIFs are designed for risk-adjusted returns. And I spoke about the myth on derivatives. See, derivatives have gotten a very negative reputation because of what we spoke sometime before, 95% of the people losing money, etc. But there is a critical distinction here. Derivatives, we know, are a financial tool. And like other tools, when used correctly, they can be very beneficial. Now, the proof of the pudding is, have we seen this before? Do we know the results, etc.? Let us take, for example, the mutual fund industry. It already uses derivatives, okay, very extensively, very successfully. We spoke about arbitrage funds. It is already a 3 lakh crore, and there is no mass destruction or risk that has happened there. Or take BAF. It uses derivative for hedging. Proven track record. Many people have made their lifetime money with BAFs. Or dynamic equity funds, tactical hedging using futures, stable performance. So we spoke about SIFs, the fund managers. It is managed by professionals who know how to use these tools, just like the categories we spoke about sometime before. So what the HNIs should still ask is, what can then go wrong? And how much of it can go wrong? Okay, it's a very important set of questions to ask, because there could still be scenarios where strategy is not working, okay, in line with, say, certain market conditions, or short positions being taken are moving against you temporarily for a temporary period, or derivatives are mispriced, okay, creating temporary losses. So these things can still happen, okay, and hence, what should we do as investors? I mentioned about a time horizon of 5+ years. Okay, please give that time horizon to smoothen out that volatility. That is number one. And two, don't put all your eggs in one basket. Strategy diversification is important. Okay, and hence within an AMC or across AMCs, don't put all the investments in one SIF type, spread it out. Number three, you spoke about it, choosing the right fund managers, right AMCs with proven experience, derivatives and hedging experience. So from a risk standpoint, for new investors in SIF, I would say the bottom line is, see, these are sophisticated strategies. Okay, it requires understanding, but they are not riskier products which need to be avoided. And if they're used correctly with the right goals in mind and giving it appropriate time, they can reduce the portfolio risk, and we know how they will do it. Okay, better downside protection and maintaining upside participation in parallel. So I would say that's how the risk part is handled in this, Rakhi. That definitely is not as risky as the myth that people are thinking about.
No, absolutely. Thanks. Thanks for clarifying. I like how you said that derivative strategies is something not totally new for the mutual fund industries because BAF and arbitrage funds have been using it, for ages. Also, one thing I think I will also clarify because there's a lot of myth that SIFs use leverage, but that is not true. SIFs are also not allowed to use leverage.
Correct.
It is only the Cat 3 AIFs and hedge funds which use leverage. SIFs also don't use leverage, so that to that extent, it's not that risky.
That's right. You are very correct. That's one of the SEBI guardrails that SIFs cannot use leverage. You cannot go beyond and amplify your portfolio through leverage. Not allowed.
Absolutely. And you mentioned about SEBI guardrails. So, my next question would be what kind of these guardrails or investor protection clauses are SEBI built into this SIF framework?
We were working very closely with SEBI on the designing of the circulars and the rules that need to be put in, etc. And I would truly appreciate the work that SEBI has done in this. SEBI has been very thoughtful in designing the framework, which balances innovation with investor protection. Okay, it is multi-layered set of guardrails. For example, number one, we spoke about the same MF regulations applying here: NAV, daily reporting, and regulation reporting, grievance part, etc. That is fundamental guardrail. Okay, same as MF. Number two, we spoke about the investment constraints. Okay, you referred to the leverage not being allowed to amplify positions, or the caps on derivatives on unhedged shorting. Okay, 25% unhedged is allowed. And diversification. You cannot put, all your money in a 2-3 set of stocks. So these are the kind of guardrails. In addition, there is a very clear guideline on the distribution control. Okay, whoever is selling SIF must clear NISM 13 exam. And this exam is not simple, wide variety of topics: futures, options, derivatives, hedging, margining, risk management. Okay, this is exactly what distributors need when they are talking to the investors, to have very informed and very meaningful conversation with the investors. And the good news is, see, we take care of AMFI, the systems for mutual fund distributors, SIF distributors, registration, renewal, etc. We saw that there were 248 people as of 31st July who had cleared and registered in the AMFI platform. But as we speak now, we are talking about 5,000 distributors, okay, and their employees have already cleared the exam. So we're talking about, say, 20x the kind of number that we saw just a few months before, which shows that, yes, the distributors are showing interest, and this as a category, okay, I'm sure it is going to gain traction with the entire ecosystem getting ready. So the bottom line, again, coming to the SEBI part, see, there is no framework which can eliminate risk entirely. Markets will fluctuate. Strategies sometimes tend to underperform. Losses can occur. So SEBI has created guardrails to prevent big catastrophic failures. Okay, and while allowing the legitimate innovation. That's what SEBI has done in this by putting in the multi-layered say controls that I was talking about across the ecosystem.
Got it. Got it. No, very clear. So all the right investor protections built into the framework, and definitely sounds good. But Sayed, tell me where does your platform like CAMS come into this picture, and what role do you play in the SIF ecosystem?
See, what we do as CAMS, we play a critical platform infrastructure role across the entire SAF ecosystem. Okay, from enabling launches and facilitating the daily operations for investors and distributors. So let me break it down further. We have built very comprehensive systems that make SIFs operationally exactly similar to MFs while handling their unique requirements that SIF demands of the minimum limit, the thresholds, minimum investment, and all of those. And this infrastructure that I was talking about has been the primary reason for enabling the rapid launches, okay, the multiple launches that have happened very recently in SBI, iPro, Tata, Bandhan, and 361 have gotten their launches done very smoothly. And there are 10 more AMCs who are lined up in the next 3 to 4 months. And for investors, the MyCams platform and the CAMS Online, these are the live platforms for SIF investments, instant KYC, transaction tracking, portfolio analytics, etc. For distributors, all the distributors are aware of the H360 platform, which they use for mutual funds, now also available for SIFs. All these live AMCs and the distributors are using H360. Similarly, for corporates, GoCorp platform with bulk transaction capabilities, employee investment programs, all of these are live. And we as CAMS, we've also taken a very proactive role in building the ecosystem knowledge on SIF. What we have done is we have run a series of programs under the umbrella called CAMS Elevate, okay, where we have met distributors across all the major cities. And SIF is a key discussion topic in that. And webinars like this, Rakhi, okay, or say a continuous series which we run, okay, with different entities and the key market players like you, and also regular training sessions with the AMCs. So for investors, okay, listening to this, this means your SIF experience with CAMS could be transacting or monitoring your investment or redeeming the investment will be as smooth as your mutual fund experience. Despite all the added complexities that come under the hood for SIF, the CAMS assurance is there like what you have for mutual funds.
No, absolutely. That really helps. Ease of operating, ease of investing, ease of exiting is really key. And, it's great that CAMS has built this infrastructure. Because then anyone who's investing in mutual fund already is then, able to do this without too much of a documentation hassle and so on. So that makes it much easier. So, Sayed, to wrap up, my final question. So, what is your outlook for SIFs over the next few years? And what is your core message that you would leave for our HNI investors who are listening to this? What is the one core message that you will leave for them?
Thank you for that question. Okay, usually you have 5 questions, I have 1 answer. This time, yeah, you asked for 1 answer, I'll give you 5. Okay, so see, one, the confidence level is very high on SIFs. Okay, that it will evolve from the current 7,000 crores to a 5 lakh crore AUM by 2028. Okay, there are a deep research that has been done by CAMS, and I've shared it in multiple other podcasts which are available in terms of the research that we have done. I was talking about, say, 4 or 5 core messages. Number 1, for investors, please remember, SIFs are not a shortcut. Okay, this is not about chasing multi-baggers or PMS like outperformance. Okay, SIFs are about better risk-adjusted returns, downside protection, and portfolio efficiency. So, number 1, please set realistic expectations. Number 2, education before investment. Please never invest not just in SIF, but in anything what you don't understand. Okay, before allocating in SIFs, read the investment document. It's called the investment strategy document. Please go through that thoroughly. And within the document, ask what can go wrong, how much of it can go wrong, and know the risk metrics. Okay, no, you should know about the volatility, the beta part, the rolling returns part, etc. So message number 2, please do not invest blindly because everyone is talking about SIFs. Invest, but don't invest blindly. Number 3, suitability of the product for you over FOMO, okay, the fear of missing out. So ask yourself honestly, do I need this risk return profile? Where does it fit in my asset allocation? And do I really have a 5+ year horizon? So SIF should fit a specific need in your portfolio, like all your mutual fund investments. It cannot be an experiment. Okay, that's a third message that I would leave. Fourth is, don't go all in right away. So allocate a small portion, okay, 5 to 10%, okay, of the relevant portfolio, allocate it there, and monitor the performance across the market cycles. I spoke about 3-year, 4-year, 5-year period, etc. Allow these cycles to happen, monitor the performance, and gradually increase the allocation once you gain confidence. And the last message, okay, Rakhi also touched upon this, the asset manager selection, the fund manager selection is critical. How do you do it? Strategy clarity. Okay, is the fund doing one thing really well on the strategy part? The track record. Okay, even though past cannot be an indicator of the future, but still look at the back tests, how that specific AMC and its funds have behaved in a volatile period. And AMC pedigree, I spoke about some names. Okay, has the AMC run quant, derivatives, or hybrid strategies before? Look for the pedigree. So, like Rakhi was asking, one message, okay, is approach SIFs. Please approach SIFs with informed optimism. Educate yourself. Assess whether it is suitable for you. Start very thoughtfully. Choose high quality managers. Monitor it, and please stay patient. Because this is not just an evolution, but it's a leap forward from the current investment landscape. And for the investors who are embracing it wisely, it can truly, truly transform both the wealth outcomes and your investment experience. Thanks, Rakhi. I think that was a great question.
So thank you so much, Syed, for the summary. And I love it because it's true not just for SIS, but for any investment decision that you make. All the 5 points that you noted are actually, I think, relevant for any kind of investment decision you make, whether SIF or not. And so true in the case of a new category like SIF and all. And thank you so much for sharing such clear and practical insights and decoding SIFs. At least for me now, it's very clear what SIFs are, why they were introduced, what is the role they play in the portfolio, who should invest, who should not invest, and how we should go about choosing the right SIF and so on. So thank you so much. It was really helpful. And any final thoughts you would like to add before we close?
I just wanted to thank you, Rakhi, for this wonderful and a very thoughtful conversation. Okay, and I would say a very engaged conversation. And I wish, okay, you and all the investors, okay, working with you, great success. Okay, from Kalpvriksh, okay, great success in their SIF journey. Thank you very much for having me here today. Thank you.